Even if the Fed signals no more rate hikes tomorrow, our next guest warns the all-clear signal is years away. Peter Boockvar is the chief investment officer at Bleakley Financial Group. He's also a CNBC contributor. So let me understand you. Welcome, first of all, but let me understand correctly. You wouldn't be surprised if the Fed is done for this cycle. You would be surprised if they say anything like we're done.
Well, they're done with respect to the Fed funds rate. They're certainly not done with respect to their balance sheet. And that's the continuous form of tightening that will continue on. So Jay Powell may just sit back and do nothing tomorrow. It's probably going to be a really boring statement. It's going to be a very boring press conference.
Great. I'm glad I'm going to Washington for this thing. You really teed it up beautifully for me.
Behind the scenes, though, QT continues on. And I think that it is taking over from the rate hikes in terms of tightening financial conditions.
So that's the key part of the monetary policy that isn't
sort of
going away.
Baton. It's going to be more of a focus. So the balance sheet has shrunk about $1 trillion. The question is how much more do they want it to shrink? Powell has said, well, we'll know it when we see it, which is their way of saying we don't really know. But it's still going on. And it's not just the Fed that's doing QT. It's global QT. ECB, the Bank of England, Bank of Canada, Reserve Bank of Australia. And while the Bank of Japan is not going that far, they're still, in its own way, tightening monetary policy.
So what do you see as we pivot away from those technical issues to the question of what's going on in the bond market, the 10-year hitting 5%? Where do you see, and it's eased back off just a little bit, where do you see it finishing the year, and where do you see it performing next year?
I think for the next couple of months, we've probably seen the top in the 10-year for now. I think we're going to get a little respite here. Maybe the 10-year trades down to 4.5, 4.75. But next year, I still think the upward pressure reasserts itself. And I think it still surprises us.
The pressure comes from where?
It's going to come from not your conventional sources. It's not going to come from the economy accelerating. It's not going to come from revisiting a 9% inflation rate. It's going to come from the Bank of Japan getting out of negative interest rates. It's going to come from continuous QT. It's going to come from still rising debts and deficits, a combination of not so good things.
Supply. That's
correct.
Rising debts. And when you say that, Karen?
Yeah, so I see some of your notes. If we get to 6%, then the Fed would do QE. Is QE the lack of QT, or is QE QE?
So the sequence will be stop QT. And then if they run into a Bank of England situation where you get this unruly rise in long rates, then the Fed will feel the need to temper that. We hope we don't get to those situations where they lose control of the long end. But it's something that, you have to use your imagination when you're in this global rise in interest rates of what actually could happen as this global monetary tightening continues on.
I'm reading your notes here that say the housing market is upside down, Peter. So, and that you say that it really there's no relief, certainly for new buyers out there. They're broken. I am of the view that housing prices have a ways to go lower. And I realize, people say there's a supply dynamic that's going to support them. But if there's no velocity in sales, and frankly, at 8%, you're buying a lot less house is the reality.
I think, and we heard it from the builders in some of their earnings calls, I think 8% has been the inflection point where they're finally seeing, you know what, we've had a good year so far, and we're selling homes to people that can't find an existing home. But 8%, people are pushing their limits. And I think some of the builders talked about that. I think that the real catalyst to get a decline in home prices is also not for good reason. If people start to lose their jobs and they need to downsize into an apartment, for example, that could be a catalyst to bring on more supply. But we need more supply desperately, especially for that first-time home buyer that's in a really difficult situation.